Welcome to today's custom-tailored deep dive. We are absolutely thrilled to have you with us today.
Truly thrilled.
Yeah, whether you are prepping for a major financial strategy meeting, or maybe you're just trying to make sense of a highly chaotic global news cycle.
Which it is. Very chaotic right now.
Oh, incredibly. Or, maybe you are just insanely curious about how the world economic gears actually turn behind the scenes. Either way, you are in the right place.
We really are.
Today, we have a fascinating stack of sources to go through, and the overarching theme is, well, it's something that has undoubtedly crossed your mind if you have been watching the geopolitical landscape shift over the past week.
Right. It's been front and center for everyone.
Exactly. So we are pulling heavily from a hot-off-the-press market analysis article. This is dated March 8, 2026.
Fresh data.
Super fresh. And this piece was written by veteran financial researcher Doug Young.
He's great. Doug is he's a former financial director. He's got over 20 years of experience navigating the absolute trenches of complex financial markets.
20 years. So he knows his stuff. And we are pairing his analysis with a really comprehensive snapshot of global financial bulletins. These were pulled directly from the Gold IRA company's Bulletin platform.
It is it's a phenomenal combination of materials. Having that seasoned, deeply experienced analytical perspective right alongside a real-time global look at the shifting headlines.
Yeah.
It gives us a true 360-degree view of what the markets are doing. And frankly, what they're doing right now is leaving a vast majority of retail investors completely baffled.
Baffled is the right word. Which brings us directly to the core mission of today's deep dive.
Right.
Here is the big question we are setting out to answer for you today.
The big mystery.
Right. When the U.S.-Iran war escalated last weekend, conventional market wisdom dictated that safe haven assets, specifically precious metals like gold and silver, they should absolutely skyrocket.
That is the textbook historical reaction.
Right. Geopolitical crisis hits, uncertainty spikes, and capital rushes to gold.
Right.
But instead, they dipped.
They actively retreated.
Yeah. Today, we are going to figure out exactly why that counterintuitive move happened, what it means for your own portfolio strategy, and most importantly, how to read the hidden signals buried in all this chaos. Okay, let's unpack this.
To really understand this anomaly, we have to look closely at market psychology and timing. The general public expects an immediate linear reaction to breaking news.
News happens, line goes up.
Exactly. But the markets rarely behave that way. We have to examine the mechanical realities of how institutional capital positions itself right before a widely anticipated geopolitical event actually crosses the wire.
Okay, I want to look at the specific data drop from the week ending March 6, 2026, because the numbers themselves paint a very stark picture of this volatility.
They really do.
Looking at the analysis, the physical metals started incredibly strong. We saw gold briefly touch near $5,500 on Sunday evening.
Right as the initial headlines of the strikes were breaking.
Yes. But instead of establishing a new floor at that high or climbing further on the panic, it reversed course. It ultimately dropped about 3% over the course of the week to settle around $5,170.
A significant pullback.
Yeah, and that was despite logging a really robust $90 daily gain at one specific point during the week. And I think it's crucial to note that it never dipped below the $5,000 support level.
Which indicates a hard floor.
Right. And we saw a similar slide in silver, correct?
We did. Silver fell about 5% over the week to close near $84. And that decline held even after it experienced a sudden $2 intraday rebound.
Wow.
So you have precious metals sliding backward across the board. But simultaneously, oil behaved exactly as one would anticipate during a major Middle East escalation.
And through the roof.
Oil surged a massive 35% to hit $91 per barrel. The sources explicitly note that this is oil's largest weekly advance in decades.
Decades. Okay, so oil is behaving predictably, but gold and silver are pulling back. It, reminds me of the dynamic you see leading up to a massive tech company's earnings call.
Oh, that's a good comparison.
Right. Everyone on Wall Street knows the company is going to post record-shattering profits, so they buy the stock heavily all quarter long.
Right.
Then the actual earnings report drops. The numbers are exactly as fantastic as everyone expected, and the stock immediately tanks.
Yep.
The smart money is simply dumping their shares to lock in profits, usually leaving the retail investors, the people who waited for the official news, holding the bag.
What's fascinating here is that you are describing the classic buy the rumor, sell the fact dynamic. The escalation between the U.S. and Iran wasn't a sudden, out-of-the-blue black swan event.
No, everyone saw it coming.
Exactly.
Why?
The broader markets had been anticipating this specific conflict for weeks. Speculators and institutional traders utilizing leveraged bets built up massive preemptive positions in gold and silver before a single strike actually occurred.
So they drove the price up on the anticipation of panic.
They did.
But wait, if the macroeconomic picture suggests that a prolonged war practically guarantees inflation through deficit spending, which we know drives gold higher, why wouldn't those professional traders just hold on to their positions?
That's the logical question.
Right. Why sell at $5,500 if the underlying fundamentals suggest it could go much higher over the next year?
Because institutional trading desks are graded on quarterly, sometimes monthly performance metrics, not decade-long holding patterns.
Short-term goals.
Exactly. When the professional traders who bought gold weeks ago saw the headlines hit on Sunday evening and watched the price spike to near $5,500, they realized the anticipated event had peaked.
The news was fully priced in.
Yes, they faced a choice. Hold a highly volatile asset through the unpredictable fog of war, or take guaranteed massive profits right now.
And they chose the cash.
They chose to cash out and rapidly unwound their leveraged positions. When that volume of simultaneous selling hits the market, it creates immense downward pressure. That's what caused that 3% dip in gold and the 5% dip in silver. They sold the news.
But oil rallied because it's different.
Right. Oil rallied because the conflict physically threatens the actual supply chain of crude. It creates genuine, sustained panic about physical shortages, rather than just speculative positioning.
That distinction between speculative trading and physical supply threats clarifies the divergence perfectly.
But moving past the immediate day trading reactions, there are massive fundamental macroeconomic forces being set into motion here.
Huge forces.
Let's talk about how a conflict of this magnitude is actually financed, because the sources bring up some absolutely staggering fiscal pressures.
Staggering is putting it mildly.
Conceptually, we know wars are expensive, but what is the actual scale of the financial burden we're looking at right now?
The raw numbers provided in the analysis are incredibly sobering. As of early March, the U.S. national debt had already hit $38.86 trillion.
At $38.86 trillion.
Yes. And against that backdrop, think tank estimates cited in the sources place the initial operating costs of this U.S.-Iran escalation at $891 million a day.
Wow. Wait, $891 million a day?
A day. So we are talking about $3.7 billion in just the first 100 hours of the conflict.
Precisely. That is $3.7 billion added to an already historically unprecedented national debt load in a matter of days. If we connect this to the bigger picture, this is exactly where the bond market begins to signal distress.
Okay.
The analysis notes that the 10-year U.S. Treasury yield climbed to roughly 4.15%.
Let's pause on that yield for a second, because that's a critical metric for you listening. When we talk about the 10-year Treasury yield hitting 4.15%, we are looking at a real-time barometer of anxiety.
Absolutely.
It essentially reflects how much compensation investors are demanding to lend money to the U.S. government. When it climbs that high, it signals genuine bond market panic over escalating borrowing costs.
Right, because the government has to borrow that $891 million every single day to keep the military machinery moving.
Every single day.
And historical precedent shows us that major unexpected wars almost universally lead to explosive deficit growth. Why? Because sitting governments are highly reluctant to implement sweeping, immediate tax hikes on the general public to pay for a new conflict.
Because it is politically toxic.
Exactly. It's political suicide. So if they aren't raising your taxes to generate that $3.7 billion every 100 hours, they are forced to lean on the Federal Reserve to essentially print the money required to finance these massive obligations.
So what does this all mean? When you take a step back and look at the whole board, the sources paint a very specific economic reality for your portfolio. We recently had weak jobs data.
Which indicates an underlying softening in the broader economy.
Okay. Add to that a sustained massive 35% surge in oil prices, which makes manufacturing and transporting goods instantly more expensive.
Instantly.
Then combine both of those factors with massive new government borrowing and the inevitable money printing required to fund a multi-billion-dollar war effort. You have just created a textbook recipe for high, sticky inflation.
The perfect storm.
And historically, this specific environment, characterized by expanding deficits and rapidly weakening purchasing power, is exactly what supports and drives the price of precious metals over the long term, making that short-term 3% dip look like a blip on the radar.
That is the crucial takeaway. The short-term dip was a mechanical trading anomaly. The long-term fundamentals pointing towards sustained inflation are the true underlying signals.
Right.
And we are already seeing this tension play out vividly in how different sectors of the stock market are reacting. There is a massive sector rotation underway as institutional money repositions itself for a wartime economy.
Let's break down those sector rotations. On the winning side of the ledger, defense contractors obviously saw an immediate bump.
As expected.
Lockheed Martin, for example, saw quick gains of 3 to 4% as the market priced in a wave of new government defense contracts. And the broad energy sector rallied hard on the back of those crude supply disruption fears. But then you look at the losing side, and it's fascinating. Gold mining ETFs took an absolute beating. The sources highlight that broad miner funds and junior miner funds, specifically ETFs like GDX and GDXJ, declined over 11%.
Over 11%.
That is a massive drop compared to the physical metal, which, as we established, only fell 3%. Why the severe divergence?
It comes down to operational vulnerability. Mining stocks act as leveraged plays on the price of the physical metal, so their price movements, both up and down, are inherently more volatile.
Okay, that makes sense.
But more importantly, extracting gold from the earth requires vast amounts of energy. Heavy machinery, transportation, refining, it all runs on diesel and crude.
Oh, right.
So when oil prices surge 35% in a single week, it fundamentally threatens the profit margins of these mining operations. It causes investors to dump the mining equities even if they still believe in the physical metal.
That is such a crucial distinction. Interestingly, the sources note that despite the severe volatility in the equities, the underlying gold-silver price ratio remains surprisingly stable.
They move down in tandem.
Right, keeping their historical pricing relationship intact. And a temporarily strong U.S. dollar is currently acting as a headwind, holding back immediate investment inflows into precious metals.
Which is entirely normal in the initial shockwave of a geopolitical crisis. Foreign capital seeks the perceived safety of U.S. currency.
Flight to safety.
Exactly. But this is exactly where looking at historical market precedents becomes so illuminating. The analysis by Doug Young explicitly draws parallels between our current macroeconomic setup and two highly specific historical eras.
I know you love diving into the historical data, but the parallels here are really hard to ignore. Which eras are we looking at?
First, the 1970s Vietnam era. During that period, the U.S. engaged in massive, prolonged monetary expansion specifically to fund the war effort.
Just printing money.
Right. That unchecked expansion directly fueled huge, sustained rallies in real, tangible assets like gold and silver as inflation ravaged the dollar. The second era, which is perhaps a closer parallel to today's mechanics, is the period immediately following the 2001 attacks. In the decade following those events, driven largely by sustained, compounding deficit spending from multiple Middle East engagements, the price of gold rose over 570%.
Over 570%. That is a staggering number. But it wasn't an overnight spike. It was a slow, grinding climb. I assume that's because the market slowly realizes that war debt doesn't vanish when a peace treaty is signed.
Exactly. The key insight that research provides is that shorter initial military engagements heavily favor equities. Capital flows into defense stocks and energy producers. But extended fiscal strain always reverses that trend.
Always.
Governments consistently and historically underestimate reconstruction expenses. The sheer cost of rebuilding infrastructure after the destruction is monumental, meaning the debt incurred won't just taper off. That structural debt and the inflation required to manage it sticks around and compounds for decades.
Here's where it gets really interesting. To be truly well-informed, you cannot just look at the U.S.-Iran conflict in a vacuum.
No, you can't.
The global financial ecosystem is highly interconnected and constantly moving. The sources we pulled from the Gold IRA Company's Bulletin platform provided a fascinating scan of the global headlines this week.
And we need to look closely at these developments. They show just how rapidly the alternative asset space is evolving while everyone else is distracted by the war.
It's vital context. The structural shifts in global wealth storage don't pause for geopolitical conflicts.
If anything, they accelerate.
Let's look at Asia first. The bulletins note that Singapore is launching a completely new gold investment asset.
That's a big move.
This isn't just a minor update. It shows that major international financial hubs in the East are actively innovating and creating new vehicles to hold physical wealth. likely anticipating a global shift toward tangible assets.
And we are seeing massive physical movements of that wealth closer to home as well?
Yes, the reports indicate that U.S. refineries are set to receive $100 million in Venezuelan gold.
100 million.
That is a massive influx of physical metal entering the North American supply chain. And it's a deeply complex geopolitical pivot in its own right, considering historical trade tensions. Furthermore, the capital flow into exploration hasn't stopped, despite the ETF sell-offs we discussed earlier.
Right, the junior miners.
The bulletins highlight that Newfound Gold just announced a U.S. $75 million term sheet to advance their Queensway development.
Which tells us that smart institutional capital is still aggressively funding long-term gold exploration and development. They're looking past the short-term ETF volatility and focusing on securing future supply.
Exactly. And we also have to look at the digital side of the alternative asset spectrum. The sources note a major headline regarding institutional crypto adoption.
This one is huge.
The state of Indiana is officially adding crypto to its retirement plans. This isn't just a tech startup experimenting. This is state-level institutional adoption, integrating digital assets into traditional long-term civic retirement infrastructure.
That is a massive leap in mainstream financial normalization.
It absolutely is. Now, as we review these global bulletins, it is important to address a couple of highly specific, politically centered headlines that were included in the provided source material.
Right. The bulletins captured two notable political headlines circulating this week. One reporting that a UAE firm quietly took a stake in the Trump family's crypto company, and another headline claiming that Trump triggered a gold rush as investors flee the U.S.
Right.
Now, when looking at politically charged headlines like these, whether we are discussing the business ventures of conservative political figures or left-wing fiscal policies, it is imperative to state clearly that our role here is not to validate the politics of the left or the right.
Absolutely not.
We are strictly looking at the raw data being reported in these global bulletins to give you an unfiltered view of the global media landscape. We aren't endorsing any political viewpoint, nor are we taking sides. We are simply conveying the ideas and headlines exactly as they appeared in the original source material.
Just the facts.
Ensuring you have the complete, objective picture of what is currently driving conversations in the financial news ecosystem.
And that objectivity is exactly what allows you to cut through the noise and build a resilient strategy. So, bringing it all home, how do you navigate this landscape? What specific metrics should you be tracking moving forward?
Good question.
According to Doug Young's analysis, Wall Street analysts are currently split on gold's immediate trajectory. Some are heavily focused on the short-term technicals and profit-taking, while others are looking entirely at the looming structural inflation.
To filter out that daily noise, the sources recommend monitoring three critical indicators.
Okay, what are they?
First, watch the Treasury yield trends. If that 10-year yield sustains a climb above 4.15%, it means the bond markets are screaming that unchecked inflation is imminent.
That's the panic barometer.
Exactly. Second, pay close attention to the rhetoric surrounding any upcoming debt ceiling discussions. The political friction over raising the borrowing limit will sharply highlight the reality of this new war debt.
And a third.
Third, track the oil trends. If crude oil stays elevated above $91 a barrel, those increased energy costs will inevitably bleed into the manufacturing and transportation of every single good in the consumer economy.
It's an incredibly complex, interconnected web. But understanding the mechanics of how these pieces influence each other is exactly what gives you a strategic advantage.
It really does.
To dive even deeper into how these macroeconomic shifts might impact your own wealth strategy, we recommend heading over to the Gold IRA Companies Bulletin website at goldiracompaniescompared.com for a wealth of related research and information.
Highly recommend it.
That's goldiracompaniescompared.com. And for your convenience, there's a link to this information right down in the description below.
The sheer volume of data we've covered today reveals a very clear historical pattern regarding how sovereign nations handle the immense financial burden of sudden conflict. And this raises an important question, one that builds on these mechanics but looks slightly further down the road.
I'm intrigued. What is the final thought you want to leave the listener with today?
We established that the government is essentially forced to print money to fund this massive $891 million daily war expenditure, creating an invisible inflation tax on domestic savings.
Right.
But the US dollar is also the world's reserve currency, which means we aren't just inflating our own economy. We are actively exporting that inflation to every allied nation that holds our debt or uses dollars for global trade.
Wow. Okay.
So if this invisible tax continues to aggressively erode the purchasing power of the dollar, at what point do those allied nations decide the cost is simply too high, stop accepting our exported inflation, and begin fundamentally restructuring the global financial hierarchy to bypass the dollar entirely?
That is a brilliant, entirely different level of consequence. It's not just about domestic inflation. It's about the potential weaponization of our own currency against our allies' reserves.
Yeah. That is a profound macroeconomic concept to chew on. And it proves exactly why understanding the deeper mechanics of these global events is so critical. Thank you so much for joining us on this deep dive today. We hope this breakdown brought some much needed clarity to a highly chaotic week in the markets. Keep a close eye on those bond yields. Always question the surface level narratives in the headlines. And most importantly, stay insanely curious. We will see you next time.